Thanks very much, Nicholas. So this is the third in a series of three presentations that Reed Corporate called the Summer Series. So every time I present these things, I'll always refresh the slide deck. So I'll start by refreshing the corporate slide. Obviously, you've got to update your share price and number of shareholders, etc. Then you obviously update things based on the new drilling that you've done from the last time you presented. And one of the things I specifically do is I actually update our sensitivity table for the scoping study that we published in September of 2023. So when we started, the gold price was sitting at 3,000. We published our scoping at 2,750. I updated in December to $4,100 an ounce Australian, and that was up from 3,750 for the September presentations that we did here on the Gold Coast. So last week, I updated it to 4,500, and obviously this week it's already trending at 46. So the gold price is up over 40% in the last 12 months, and this Mandilla study is absolutely flying at these current spot prices. We have had a pretty busy Christmas New Year period. We've launched an off-market takeover for Maximus Resources. We are doing an update to the mineral resource estimate, and we are obviously advancing our pre-feasibility. So for those that aren't aware, obviously we are gold focused. Two projects, Mandilla and Feysville, both of which are located in the heart of the West Australian goldfields. Great area, good infrastructure, the sort of operational area you want to be operating in where you can successfully develop and operate a gold mine. A well understood mining code and a very, very supportive community and government for mining there in Kalgoorlie. With the scoping study, it's demonstrated 100,000 ounce per annum gold producer for the first 7.5 years. It was printing solid cash at $2,750. It is minting it at $4,500. We've demonstrated regular resource growth since we got involved in 2020 with Mandilla, and now since pivoting to Feysville, we are continuing to demonstrate our ability to grow at sub $20 an ounce in exploration costs. We've completed a number of infill programs at Mandilla, and as I said, we are now updating the mineral resource estimate for Mandilla, which will lead into the pre-feas work for the June quarter. At Feysville, we have an AC rig currently drilling some lines of air core and an RC rig coming in towards the end of the month. So just quickly on the Maximus Resources merger, we're offering a compelling premium here. It was a 60% premium to the undisturbed share price and a 50% premium to their 12-month high. It is a good transaction for both Maximus and Astral shareholders. As far as our pre-feasibility is concerned, there will be no changes to the pre-feasibility based on whether we are successful or not with regards to this merger. The gold deposits from Maximus will not make their way into the pre-feas, but we have previously acknowledged that if we do have a weakness at Mandilla, we have a relatively small tenement footprint. And this transaction gives Astral optionality with regards to that. Currently, the pre-feas is aiming just at Mandilla alone. It'll be 10 years worth of mining, 15 years worth of processing. But beyond that, you want tenure to be able to target future ounces, and that's what Maximus offers us. Tenement footprint would go from 27 square kilometres to just over 140, so it's a 400% increase in tenure. We're of the view that if you put in a decent amount of exploration expenditure, Maximus can generate several 100,000 ounce deposits that are likely to be higher grade than Mandilla, so we can then push them into the schedule as we go forward. The transaction's only 1 week old and we're currently trending at 40% ownership, so we're certainly confident the merger will go through. Now, just on the scoping study, as I've already said, the impact of the gold price to these studies is just unbelievable, and I actually can't wait to update this slide with the pre-feasibility numbers, as I said, that we're aiming for the June quarter. So to reinforce, 7.5 years, 100,000 ounces per annum, 1.3 grams per tonne, 5.8 to 1 strip ratio over the three deposits that make up the scoping study. Our mining costs were $11.60 per BCM when we put this study out in September of 23, when our peers were at $7 a BCM in mining costs. We've just recently been out to market to update that for the pre-feasibility, and that's actually trending lower than where we were at scoping. From spot price perspective, at the moment, this project will generate $130 worth of free cash flow margin per tonne. Multiply that by 2.5 million tonnes per annum. It's over $300 million worth of free cash flow every year for the first 7.5 years. So that's what the sensitivity table looks like. At $4,500 gold price, internal rate of return is 195%, free cash flow $2.2 billion, net present value at an 8% discount rate post-tax is $1 billion worth of value there. Simple bulk scale mining, really strong metallurgy. I'll be putting out some more metallurgy numbers in the next week or so. So it's tried and tested processing, so low risk. The peak negative cash flow for this project was $191 million at scoping. I'm yet to get the CapEx numbers, and I certainly expect some movement. I'm not naive that the number is going to go down. It'll go up. But at 175 mil market cap and a strong institutionally backed register, we are a company that can absolutely fund this into development. So just an update on the pre-fees. Permitting is expected to be relatively simple. It will be permitted at a state level. It will not go to the federal government for approval. From an OPEX perspective on processing, those costs have come through. That's trending at about a 13% increase in processing costs. Bear in mind, from scoping study to where we are today, the gold price is up 50%. So if my processing cost, what it cost me to put a tonne of ore through the mill, is up 13%, I'm going to take that as a very big win. With regards to power, we've just got a draft power review through. Given our location in that Kalgoorlie area, we actually have the ability to connect into grid power, which will be a significantly cheaper outcome than what we had in scoping, where we're looking at gas reciprocating engines and solar, because the gas price has moved a lot since September 23 to where we are today. With respect to mining, as I said, we've been out to RFQs. Those costs are coming in, and it is trending lower. With the scoping study, we were $50 a tonne all in at scoping, and mining represented 60% of those costs. So if those costs are trending lower, it is almost impossible for the pre-fees to not blow the absolute bejesus out of the scoping study financials. So we are expecting that when we publish later in this financial year. Met testing, as I said, some more results out next week. Geotech, still in progress. Cube Consulting are doing the mineral resource estimate, and we are targeting the June quarter for the pre-feasibility. So just on the corporate slide, obviously every MD is going to stand up here and say our stock is cheap. The only thing I will point to here is on an enterprise value basis, we're only worth about 11% of the net present value of the scoping study. So the market cap is still very much undemanding. The other point I'd like to make on this slide, and I mentioned this in December, is the biggest change between Astral Resources today and let's say this time last year, is this time last year we were a company that actually wanted to develop Mandilla. But now, where we stand financially today, we are a company that absolutely can. And the best way to explain that is March last year, we raised money at 5 cents, largely high net worth, and the reality was raising capital was difficult. Fast forward 12 months, we are a 175 mil market cap company, 23% institutionally held, research coverage by both Canaccord and Euroz Hartleys, and in every sense of the word, we are now a company that can fund ourselves into development. Just quickly on the resources, we have demonstrated our ability to continue to grow effectively. Mandilla, since we started in 2020 to today, 1.3 million ounces at $17 per ounce exploration cost. The market is valuing us at $104 an ounce at the moment. So it is very value accretive to add new ounces at $17 an ounce. Similarly, we've pivoted to Feysville and we've added ounces there at $19 an ounce. We are a cost-effective company when it comes to growing our business. Also at Feysville, of the 200,000 ounces we have there, 150,000 ounces of that will mine in 3 relatively shallow open pits at 1.3 grams per tonne and a 6-to-1 strip ratio. At current spot prices, pushing that into a low-cost Mandilla process plant will make a tremendous amount of cash, and you'll see that when we update the pre-feasibility in the June quarter. So just on Mandilla, it's located close to this regional structure known as the Karramindie Shear. So that runs through the region, and pretty much where Mandilla is, there's a deflection, and that deflection gives you this classic structural target for gold. 4 deposits, Thea, Iris, Hestia and Eos. Only 3 of them went into the scoping study. If we do our mine designs at 2,600 Aussie, then an extra 100,000 ounces will drop into the pre-feasibility. So you can see how quickly this study will continue to grow. and the spot price being over 4,500, if we're designing at 2,600, it is still very, very conservative, which is actually a hallmark of our business, to be honest. Here's a long projection of Mandilla. We did of Thea. We did a 4-hole diamond program. This is infill drilling. This is converting inferred ounces into indicated. We're drilling in a southeasterly direction, so it's a really effective way for us to cover a large part of the ore body and convert as much inferred into indicated as possible. All holes hit visible gold. The program averaged 401 gram metres, so you sum all the intersections for each hole and then we average it across the 4. So over 400 gram metres of gold for that program. Best results: a metre at 220 odd grams, 2.5 metres at 170 grams, 10 metres at 28 grams, 4 metres at 7, 25 metres at 4, 28 metres at 3, 72 metres at 1.2. A very effective drill program, and with the resource estimate that is being updated, we're very confident that we'll be successful in converting those inferred ounces into indicated. Another important point around Thea: it's a plus 1 million ounce deposit in a single large open pit. It is the biggest deposit in our region that is owned by Junior, and is the third biggest when you include the Super Pit and Red Hill, both of which are Northern Star deposits. So it is very rare in this area. Now, a couple of slides on Feysville. As I said, Mandilla presents 10 years worth of mining, 13 to 15 years worth of processing. Feysville is the icing on the cake because the grades will likely be high grade and we'll be able to displace some lower grade Mandilla ore, probably from about year 3 in the schedule. So this will make a lot of money as we add it into the pre-fees. Currently 196,000 ounces at 1.2. Feysville is located in the Norseman Lunar Belt and is bounded to the west by the Boulder-Lefroy Fault. There's these structures there that trend north-northwest through the project area, and that includes the ethereal shear which runs through the middle of our package. Now, these north-northwest structures are actually cross-cut by a D4 offsetting fault, and that offsetting fault is actually important regionally in locating gold because the Mount Charlotte deposit, which is at the Super Pit, is one of those deposits that's thought to be associated with the D4 offsetting fault. Now, moving on to Kamperman, that's a new discovery, 84,000 ounces at 1.3 grams per tonne. This long projection, we assayed an RC hole, FRC 378, 25 metres at 24 grams per tonne. 1 metre was 420 grams per tonne. So we went back to the RC chips, panned it, and that's all the visible gold you can see in that picture. This result came after the mineral resource estimate, so it's not in the mineral resource. Similarly, this slide here, a cross-section through Kamperman in the southern zone, 33 metres at 4, 22 metres at 4.4, 22 metres at 5 grams per tonne. Again, one line of drilling, all 3 significant mineralisation, not in the mineral resource estimate, so it presents as upside. We've just done a 3-hole diamond program here at Kamperman, and those results are pending as well. So to wrap it up, Astral Resources, we are well funded, $25 million in the bank. We are on track to deliver our pre-feasibility for the June quarter, and then we are also funded to get to a final investment decision, which will be 12 months after we deliver the pre-fees. So all the money is in the bank to achieve that. We are still drilling. We've consistently demonstrated our ability to grow at less than $20 an ounce in discovery cost, and we want to keep growing. We are committed to delivering value for our shareholders. So that's our Astral shareholders and the new Maximus shareholders, which we'll be welcoming onto the register with the off-market takeover that's currently happening. Fantastic jurisdiction to be investing in, infrastructure rich, strong community support, good local government support, and a really well understood mining regulatory framework. To reinforce it, it is a conventional gold deposit. From mining through to processing, scoping study shows that it will print a lot of cash and the pre-fees will absolutely be bigger and better. Thank you.